Good afternoon, everyone. Welcome back to the Peterson Institute for International Economics. Some of you have been here all day, which we love. I'm Adam Posen, president of the Peterson Institute, and it's my pleasure to welcome you to our latest semi-annual Global Economic Prospects meeting under the leadership, intellectual and otherwise, of David Stockton, of whom more in a moment. Many of you have been with us through the years where we had Mike Musa and now David running these. We're very proud of our record. We do not run a huge macro model. We are not a forecasting shop, but we obviously pay attention to other people's forecasts, notably the IMF WEO, but other private sector and public forecasts, and we form opinions. We hope very thoughtful opinions on places where the official forecasts or the market forecasts seem to be at odds with what we think is going on. And so what we try to do twice a year around the time of the WEO release, around the time of the meetings, is give our friends out there in the press, in the markets, in this room, a look at where we think the consensus is a little off and where we think the risks are that either are exaggerated or the risks are that are overlooked, as well as giving you on the most important countries, US and China and the Euro area, our baseline forecast. Today we'll continue in that tradition. Previous meetings have had Barbara Kochwar flag problems in Brazil long before most people glommed onto it. David Stockton with some very prescient remarks about Fed behavior and about the unemployment rate. Nick Lardy on the underlying strength of the Chinese economy, and so on. And today, I'm sure we'll have many similar insights, which are of both policy and market interest. Our format is we have 4 presentations. The leadoff is David Stockton, who, of course, as many of you know, was for 11 years the chief economist of the FOMC, of the Federal Reserve, and the head of the forecast, as well as head of the Division of Research and Statistics. And we're delighted to have him with us for the last year and a half or so. He also, of course, is a senior advisor at Macroeconomic Advisors. Dave will speak for a to-be-determined period, but he'll be very disciplined, on particularly the US, but also the global outlook, and give you a sense of where he sees the main balance of risks. We will then have a presentation slightly briefer by Nick Lardy, our esteemed Anthony Solomon Senior Fellow, and everyone in the US's deserved China guru. Nick will be updating his views on the risks of financial fragility in China, or I should say the risks from financial fragility in China. That will be followed by Angel Ubide, who is a senior fellow here for the last year, but also spends his day job at D.E. Shaw as a global strategist. He will not say anything that will get him in trouble with the regulators. He is here as a scholar and economist. And he will be talking about some places where the markets seem to have the risks assessment wrong. And then finally, we will have our longtime colleague, Nicolas Véron, who is, of course, visiting fellow here since 2009, and but also is a senior fellow and is one of the co-founders of Bruegel in Brussels. And he'll be talking about some potentially positive news as well as risks coming out of the European banking, what do we call it, banking union exercise? Asset quality review, yes, the AQR, thank you. Unlike many of our panels, we're going to have our 4 speakers each speak in turn, then they'll come up here and we'll take questions from the audience. The entire meeting is on the record. Their PowerPoint presentations will be available from our website. In fact, they may be up there now, but they will certainly be up there by the end of the meeting. And thanks to our team, we now have fabulous HD webcasting, and we say hello to the viewers around the world. With no more delay, David Stockton, please.
Thank you, Adam. I appreciate that. So I'm going to start out by talking a little bit about the U.S. economy. I think the good news is that we have probably achieved what is going to have to pass for escape velocity for the U.S. economy at this point. I think the bad news is that we have achieved a low-altitude geosynchronous orbit, meaning that we're not that far off the ground, and every time you look out the window of the capsule, it doesn't look like you're getting anywhere. And that's not completely true. We have made some progress here over the past few years in the U.S. economy. Growth last year, about 2.5%, was actually a little stronger in the second half than I was anticipating. I'm expecting growth to pick up a little bit further this year, and then again in 2015 as well. Those paces are above trend, and so I would expect that to continue to erode the margin of slack that exists in the U.S. economy by some. And with labor markets tightening up and growth improving, I would expect some movement upward in inflation. Having said that, I think what I'd really want to stress about the inflation forecast is that I'm expecting inflation to remain exceedingly subdued over the course of the next few years, and not even to get back to the Fed's 2% target by 2016. So this is an economy that is generating some growth, it's improving on the margins of slack, inflation's picking up, but it's still going to be quite low, I think. In terms of the foreign economic outlook and the environment in which the U.S. economy is going to be both contributing to and receiving contributions from, I think the euro area is likely to continue to grow slowly, gradual improvement. I think Adam Posen said about a year and a half ago that the sort of policy configuration for the euro area was such that it was both creating a floor for growth and a ceiling for growth, and that still feels right to me in terms of the basic look for the euro area, which is turning out pretty much as expected. The end of a recession, gradual pickup. The expansion of the United Kingdom does look like it's gaining some real traction, and I've become more optimistic about the outlook for the UK economy. To be sure, to date, much of that improvement has been in the household sector, both housing and consumer spending, but I think the more recent data provides some hints that, in fact, that growth is broadening out to include some increase in business investment and some improvement in exports that probably is following from the improvement on the ground in Europe. In Japan, I mean, there's been quite a bit of concern about whether the increase in the consumption tax that took place at the turn of the month was going to significantly derail the expansion at this point. I don't think that's likely. I think there's probably enough underlying momentum in the Japanese economy. I don't think it's likely to become a boom, but I don't think we're looking at any serious significant shortfall from this point. As of yet, we don't really know the full package of potential structural reforms that the Abe government is going to propose. I think if those were sufficiently bold, there would likely be some upside to this forecast coming about through greater structural reforms and its implications for both demand and supply. For China, I think the outlook is one where we continue to sustain above 7% growth, maybe a little slower than it has been, but not much. Nick Lardy is going to talk about some of the risks associated with that economy. They probably are accumulating to the downside, especially in property markets. And India, like many other emerging market economies, is going to be stuck on a slower growth track as the capital flows become less favorable and policy has to lean against emerging inflation pressures, but again, not sufficient to derail. So this is a fairly optimistic outlook on the global economy side. You know, for the U.S. economy, whether one sort of buys into a view that we are in the process of picking up depends a little bit on how you're interpreting what have been admittedly quite weak data here for the first part of the year. I think current assessments of growth in the current quarter are probably somewhere in the neighborhood of 1%, and we've seen quite a few weak readings. So how to interpret that? One can question one's ability to forecast the economy, but I'm pretty good at forecasting yesterday's weather. And I can tell you, it was a cold winter, and it was a cold winter here and across the country. So my colleagues at Macroeconomic Advisors run a model that relates weather conditions to monthly GDP. It leans especially heavily on heating and cooling degree days. And those estimates suggest something on the order for the first quarter of the year of a subtraction of about 1% off of GDP growth. And that was after a subtraction of a half a percentage point off of growth the quarter before. So that explains much, but not all of the slowdown that we've observed. Some of the slowdown is associated with the end. The second half of last year was probably exaggerated for the U.S. economy because we had a significant spurt of inventory investment that wasn't likely to be sustainable. There are, however, pieces of evidence to suggest that this weather story is now behind us, abating, in addition to the fact that we have sunny, warm weather today. We've seen increases in purchasing managers' readings on the outlook for the industrial sector. Motor vehicle sales bounced back quite nicely last month. Hours worked, both for the economy as a whole and especially in the manufacturing sector, looked quite strong. All suggested that we're getting some bounce back from the weather. And I think the single most important high-frequency indicator of activity in the United States is our initial claims for unemployment insurance, and they're giving no sign that there's been any underlying softness or weakening in the U.S. economy here. So I'm sticking with the forecast that this, in fact, has been the slowdown in data has been largely weather-driven, and that we're going to get a big bounce back. I would just caution everybody, if that is right and we get this bounce back, I predict everybody will be looking at strong second quarter figures saying, wow, maybe this means the U.S. economy is really taking off. Just remember, we're going to see, if we do see strong data, it's more likely offsetting the weak data that we saw in the first part of the year. In terms of the single most important macro factor that I think drives a forecast of acceleration in activity over the course of the next year or so is the end of the very substantial fiscal drag that we had in both 2012 and 2013. That now looks to be behind us, and that drag amounted to roughly 1.5 percentage points or more off of GDP growth in 2013, and I think there's largely going to be close to neutral on federal fiscal policy over the course of the next 2 years. Monetary policy, on the other hand, I think we are approaching the end of this period of extremely accommodative policy. One is, I do think the Fed is on track to complete its QE policy, as they have announced, probably by the middle of this year. I see nothing in my forecast that would necessarily deflect them from completing QE in the fall of this year. I suspect by the middle of next year, the Fed will begin raising the funds rate in the context of growth that has picked up a little more noticeably above trend, and maybe inflation moving back some. And when they do so, I wouldn't be surprised, and in fact would expect that they may raise the funds rate faster than is implied by the dot picture. Their own interest rate forecast is implied by the dot picture that has been referred to. In terms of aggregate demand, one of the things that we talked about last at our meeting in last October was that the Fed's what I thought was premature talk of tapering last spring, which resulted in a significant backup in long-term interest rates, would leave a mark on activity in the U.S. economy. And I think it, in fact, has. I think the area where you can see that most clearly has been housing, whereas you can see on the left-hand side of this exhibit how new home sales sort of flattened out before the bad weather arrived. So this is more than just a weather effect. Clearly, the existing home sales have been more heavily affected by the bad weather, but there's no doubt we saw some softening in housing demand even before the weather, and I don't think that can be the complete story there. I think that's a bit worrisome, and in fact, while I am forecasting the housing recovery to remain on track, because housing affordability still has remained quite high, and I'm looking at house prices, certainly are not suggesting that there's been some substantial weakening in housing demand. But this is an area I'm going to be watching carefully, because I do think if I was to look at it for a downside risk in my own forecast, I'd say the housing forecast would be the area where I'd focus most heavily. In terms of consumer spending, I do think it's quite likely that we're going to see stronger growth in consumer spending over the course of 2014. in addition to the fact that the labor markets have improved somewhat, I think the condition of household balance sheets has improved quite dramatically. As you can see on the left-hand side, in terms of the liability side of their balance sheets, there really has been a significant amount of, thank you, deleveraging that has occurred. And I think that certainly bodes well for households' wherewithal to expand their spending. And then on the asset side of the balance sheet, there has been obviously a dramatic increase in net worth to disposable income, which was likely to be associated with consumption growth faster than income and some decline in the saving rate. So I think we're looking at, and of course, that has been driven both by faster growth in house prices and the considerable surge that we saw in the stock market last year. So I think there's substantial reach on both the asset and liability side of the balance sheet to support stronger consumer spending going forward here. The one area that remains disappointing, and and in my forecast is still pretty soft, is the outlook for business fixed investment. As you can see here, we did see a pretty reasonable rebound in both the orders and shipments of capital goods early in the recovery, but really for the last 2 years, that trajectory has gotten much shallower. And it's the case, of course, that orders are still outstripping shipments, which means backlogs of orders for capital equipment are continuing to rise. But the pace of business spending has really been quite soft. And the business people, at least that I speak with, are giving no sense of any urgency to expand their capital spending plans significantly. And I'm expecting this to remain on the soft side, which I think really is, in some sense, certainly surprising relative to what one would consider to be the fundamentals on investment spending, which corporate borrowing rates remain very low. Firms are sitting on huge piles of internal funds that they could be able to deploy at relatively low cost on capital investment projects. And one area that we certainly heard a lot from business people over the course of the last few years was that significant uncertainty about policy in Washington was restraining investment spending. Now, there's probably lots of different measures, but this particular measure by Baker, Bloom, and Davis, which has received a considerable amount of attention, shows that, in fact, now economic uncertainty has fallen considerably. So, and we're still not seeing that clear signs that that is leading to faster growth in investment. Let me turn from the demand side of the economy, I think, is looking better. I think there will be continue to be driven mostly by the household sector. Business sector is going to follow, not lead. The supply side of the economy, I think, is where some even greater uncertainties remain. And one of those uncertainties is just how much slack remains in U.S. labor markets. And I've shown here two different measures of utilization of labor in this chart, one very broad and one very narrow. The broad measure, the so-called U6 unemployment, which just takes all the people that would conventionally be captured by the unemployment rate and adds to that people who have been discouraged from looking for work just because they don't think anything's available. It also includes people that are so-called marginally attached, that is, they've looked sometime in the last year but haven't looked recently for a position, and also includes people who are working part-time for economic reasons. And as you can see by that measure, they're still roughly 2 percentage points, that rate is still roughly 2 percentage points above its average between 1994 and 2014. A different picture is painted by just looking at short-term unemployed individuals. One reason for looking at this narrower measure is there has been a spate of research recently, some done by Alan Kruger, some done by Bob Gordon, and some done by my colleague Joel Prakken at Macroeconomic Advisors, that suggests that in explaining movements in inflation, it's really the short-term unemployed that are the most important in driving inflation. So there's two ways of thinking about this. One is that short-term unemployment and long-term unemployment have been so collinear over all past sort of business cycles that you could never really get any traction on trying to differentiate their impact. And so this more recent research uses the fact that, in fact, long-term unemployment has been much higher relative to short-term unemployment in this downturn than had been the case in the past. So that the researchers that are finding this are arguing that, geez, now we finally can make this determination. A skeptical view of this research would say, well, what we now have is one observation, and you better not draw too many firm conclusions based on one observation, which you would just have this one cycle where things have been different. And I think there was probably that kind of thinking that led Chair Yellen at her press conference last month to say that it was tremendously premature to buy onto this view that it's only short-term unemployment that really matters. I think I'm pretty much in her camp. I would take out the tremendously. I just say it's premature at this point because I do think the evidence has to be taken seriously. But there are reasons, other reasons for, in fact, not taking it at face value yet. And one of them are just how different other labor market indicators are continuing to show a U.S. labor market that is underperforming considerably. And you can see this both businesses remaining very reluctant to hire. The hiring rate is well below pre-crisis average. It's on the worker side, workers very reluctant to quit jobs in order to move to other jobs, I think for fear that they will not, in fact, be able to find a different position. Involuntary part-time employment remaining exceedingly high. I think this is an interesting issue because here are people who are reporting that they are available and want to work more if the hours were there. They're not saying they need higher pay in order to work more. They're saying they would take more hours. So here's a margin which labor demand can be expanded, and a supply of labor available with very low wage elasticity. And these people are already holding jobs, so they have the qualifications to do this work. So this isn't a question of mismatch. So, I think it still looks like this is a labor market that has capacity to grow more strongly. One of the additional reasons that I would be skeptical that we are yet approaching capacity in labor markets is just the behavior of hourly labor compensation itself. The employment cost index is probably the best single, most comprehensive measure of compensation, labor compensation for the United States, and it's just shown absolutely no tendency to pick up, even as the unemployment rate has come down. Average hourly earnings, which just focuses on wages and is also affected by the composition of the workforce, has shown some pickup, but it also has remained at a very subdued pace, really not suggesting that there's much of any pressure. And then an alternative measure of labor compensation taken from the national income accounts, considerably more noisy, but also suggests labor compensation just isn't a significant problem at this point. In addition, I would argue that if we saw some acceleration in wages, that doesn't have immediate policy implications to suggest that policy needs to begin to tighten quickly, in large measure because I think there's considerable room for wages to grow without putting upward pressure on prices. What we've seen in this business cycle is a real collapse in labor share of income, and at the same time, an incredibly high profit share. Margins are quite high. I think margins, in fact, would absorb some acceleration in underlying labor compensation. And I think this particular picture is symptomatic of an economy where it is still the case that there is weak demand and excess supply of labor, and not one that is pressing up against any significant constraints. In addition, even if it was, and even if we saw some upward pressure, that would be a good thing because inflation, in fact, is running too low in the United States. We're well below the Federal Reserve's 2% target on aggregate, on total inflation, if you look at core inflation, and we certainly have seen no evidence at all yet of any deterioration in inflation expectations. So I think we're still operating both with excess capacity in labor markets and an inflation rate that is too low. And we're not alone. I think if one certainly looks at many of the major advanced economies at this point, inflation remains well below target. In the case of the United States and the Euro area, obviously we slid further below the target. In the case of the UK, after having run well above target, have now moved back down to target. And the readings on inflation for these economies thus far this year are even softer. So I think it's still the case that we're not facing any substantial inflation pressures. And on my forecast, I think we'll see some gradual movement back towards those inflation targets, but we won't get there for at least for the U.S., the euro area, and for the United Kingdom. Japan will probably bounce above the target this year, given the effects of the consumption tax increase, but probably even still fall short of their objective of getting to 2%. And there's a reason for that, I think, which is I think these economies are continuing to run with unemployment well above full employment. Now, I don't have to estimate the natural rate or the NAIRU or full employment for these economies, you'd like a well-articulated, well-developed structural model of the labor market. I don't have those models for these economies, and quite frankly, neither does anybody else. So thinking about what might be a plausible range, on the pessimistic side, suppose we just took the average of the last 15 years. And that would give 1/3 weight to the high unemployment rates that we've experienced post-crisis as sort of being structural. You can see and that's what's shown by the black bar here, even by that pessimistic measure, these economies, with the exception of Japan, continue to have excess capacity. Another way to look at the question might be to say, well, what's the lowest unemployment rate that these economies have achieved without putting upward pressure on inflation? So that's what the red bar shows. It shows the annual average unemployment rate for which inflation was either unchanged or lower over the preceding year. So I think I don't take either of these two measures seriously, but they give you a sense of the range of uncertainty about these measures. And again, on my forecast, I'm certainly expecting maybe the U.S. perhaps to edge into the upper part of this zone over the forecast horizon, but for the euro area and the United Kingdom, probably to remain above. And of course, in Japan, the idea is to generate some pressure on wages and to put some pressure on prices. So while trying to measure output gaps for Japan is an exceedingly challenging task, I think it's the case that I wouldn't worry about that right now, the low unemployment rates there. The point I think that I'd want to make about this is not so much any of the point estimates or where the forecast lies with respect to these bars. It's how much uncertainty policymakers currently face about the supply sides of their economies. And I think that has some implications for how they think about policy in sort of a risk management way. So one case would be for policymakers to assume there's a lot of slack when there isn't. And we kind of know what the potential outcome would be there. There's more likely to be more inflation. There would be some risk of unmooring of inflation expectations. Some people would argue, given the configuration of these economies, that might not be an altogether bad thing, given zero nominal interest rates. Somewhat higher inflation expectations might actually provide a boost to activity. But still, I think overshooting their inflation targets would not be costly, but they do have conventional policies that could be employed to address that. The second case would be for policymakers to assume there's no slack when in fact there is. And this seems to me to be a more troubling case. You end up with slower growth and higher unemployment than's necessary. We've already seen that we're already higher than most estimates would be. You get lower inflation, but inflation's already exceedingly low. And I think a more serious risk is that the policies themselves that might tighten prematurely would end up turning what could be just cyclical unemployment into structural unemployment. And in fact, that then has very long-lasting costs that would be difficult to address. Now, I know these posed this way, it looks like this argues definitely in favor of much more expansionary policy. And I think there is a case that policy in these economies needs to be more expansionary. But it isn't an ironclad case. And in fact, I think the bigger issue for policymakers in these advanced economies is not going to be so much confronting higher wage and price inflation, but is in fact going to be more questions about financial stability and whether or not expansionary policy settings currently, or even more expansionary policy settings, could be creating more difficult financial stability problems going forward. My three colleagues will address various parts of the world and various pieces of this question about the financial stability situation in major economies, and I'll turn the floor over to Nick.
Okay, well, financial instability in China. I talked a little bit about this at our fall Outlook meeting, and I'll give you some more details today. I think the consensus, however, that has emerged over recent months is much more strongly bearish. There's a financial crisis in the near term. I think that's an emerging consensus view. A minority view is that the Chinese authorities will moderate the growth of inflation in order to reduce these financial risks, but that this will lead to a very substantial and sharp economic slowdown. So I'm going to look at both of those issues, focusing primarily on the first one. Now, what are people looking at? Obviously, they're looking at the very sharp growth of credit. You can see a very substantial increase in credit in China since 2008. We've got about a 65 percentage point of GDP spike up in the growth of credit to the private sector relative to GDP. This has been a frequent harbinger of credit crises in other countries, financial crises. If you throw in public sector debt as well, you get up to an even higher number, and the spike is somewhat larger, something in the neighborhood of about 70 percentage points of GDP from the end of 2007 to the end of last year. In addition to that, many people are worried about the rise of shadow banking, which now accounts for an increasing share of what the Chinese now call social financing. It's a more comprehensive measure of credit. Shadow banking was very, very small 5 or 6 years ago. Now it's accounting for roughly 30% of social financing. So the view, of course, is that that means a substantially larger component of the credit that's been extended in recent years is through this more lightly regulated part of the financial system, increasing the risks associated with the rapid growth of credit. We also find many people, of course, commenting, I think quite correctly, on the fact that the buildup of credit has resulted in a very substantial increase in the leverage in the corporate sector. You look at it as credit to the corporate sector as a share of GDP. China's an outlier on this sample of countries from World Bank data. If you want to convert this into debt equity ratios for the corporate sector and the non-financial corporate sector, China's at roughly something like 85%. Again, it's the highest in Asia. So the leverage obviously has gone up as the quantity of credit has increased. And combining that with the slowdown in economic growth, as shown in this chart, obviously the big increase in credit allowed China to grow fairly rapidly during the global financial crisis and its immediate aftermath. But since 2010, we've seen a fairly significant slowdown in economic growth. And as Dave has just indicated, he's forecasting a little bit slower growth this year and a little bit more of a slowdown in 2015 and 2016. So the combination of rising leverage in the corporate sector with a slowdown in growth, a slowdown in top-line growth obviously means a slowdown in profits. And when you start digging down into some of the sectors in China, this is just a few examples, looking at profit margins in some key sectors of the economy last year as compared with averages of two earlier 5-year periods, you can see some of the sectors, some of the big sectors like steel. Remember, China's producing 48% of the global steel output these days, about 750 million tons. Margins in the steel sector have shrunk very dramatically. Aluminum is an even worse case. So people that are worried about a financial crisis are looking at this corporate sector with higher leverage, slowdown in GDP growth, slowdown in profit growth, and the result has been that we've seen a significant, the first defaults, I wouldn't say it's a significant number, it's a relatively small number so far, but for an economy that rarely has any defaults, we've seen over the last several months defaults on wealth management products, foreign currency bonds, trust loans, corporate bonds, And the authorities, even starting with the premier himself, have said that the number of defaults is likely to rise. So this has given some foundation to the view that China is heading for a financial crisis, a combination of all the factors that I've just gone over. Now, what I'd like to do in the next few slides is kind of give you another point of view that leads me to the conclusion that the risks in the financial sector have been perhaps somewhat exaggerated. And perhaps the most fundamental of these factors to take into account is that bank lending in China is entirely financed by deposits. If you look at bank lending relative to deposits, it's only running at about 70%. Banks are required to have 21% of their deposits on reserves at the central bank. Banks also do some lending in the interbank market to non-bank institutions. This particular diagram looks at bank loans plus bankers' acceptances, and you can see that credit to deposits is a little bit higher, brings it up to about 76%. Then if you throw in everything, all the off-balance sheet lending and lending by non-banks, it brings the ratio of total credit to deposits to about 90%. So remember, this is an economy with a savings rate, as Martin reminded us in his column today, of roughly 50% of GDP. And the result is that even though you've had a huge increase in credit, it's still basically deposit financed. It's not being financed through borrowing in the wholesale market. And I would underline, in particular, if you look at the 5 systemically important financial institutions in China, their dependence on borrowed funds to finance their loans is minimal, something in the low single digits, dependence on borrowed funds through interbank markets, repos, and other mechanisms. So it is a deposit-based financial system, not a lot of wholesale reliance on wholesale deposits that are subject, wholesale funding that's subject to sudden stop. In addition to that, the shadow banking market in China has grown rapidly, but depending on what estimates you use, and you can see in this diagram, it is bigger than the emerging market average, but it's way less than the global average and way less than the size of the shadow banking system in the United States. So it's still relatively small compared to these metrics. Another factor that I think is mitigating is that China still has a plain vanilla financial system. This is all the bank and non-bank lending outstanding, something in the order of 190% of GDP, and you can't see that little slice on the right-hand side. That's 0.2%. That's the percentage of all these loans that have been securitized. China has a very, very modest amount of securitization, a little bit on asset-backed securities. They've had a very experimental pilot program to securitize home mortgages, but this is not a market in which assets get packaged up and securitized and resold. Almost all the loans that are made stay on the books of the financial institutions that made the loans. Now, external debt is rising a little bit for China, but I'll remind you what I showed you last fall, and that is China's net international investment position is extremely positive. They still have the second largest net international investment position of any country in the world, second only to Japan. It is running at the end of 2013 at about almost $2 trillion US dollars, and that's equal to 173% of all of their external debt. So I think these factors have to be taken into account when we are trying to measure or estimate or judge the prospects for a financial crisis. Finally, I'll give you 2 last slides. The first shows that the rate of growth of credit has already moderated quite significantly over recent quarters, and if the authorities stick to this path, eventually we'll get to a situation in which credit to GDP reaches a plateau and then gradually comes down. We've seen this in previous episodes in China over the last decade, and I think we're likely to see a slower growth of credit over the next few years than we've seen over the last few years. Now, of course, that brings me to the second negative outcome that is a view one reads, only a minority view, I would say, but the view is quite simple. Once credit growth slows down, we're going to see a dramatic decline in GDP growth. One well-known person is forecasting that China's average GDP growth over the next decade will be between 3 and 4%. Again, I'm not so pessimistic. If the government follows through on its promises to liberalize deposit rates, deposit rates will go up. Banks will pass along some of those higher costs of funding to borrowers, and I think that will move more credit into the private sector. And as you can see here, the private sector has a return on assets that's roughly 3 times that of the state sector. So if we liberalize deposit rates, have higher lending costs, we can have a slower growth of credit. And one other factor I don't want to forget to mention, and that is liberalization or demonopolization in the services sector, where the state is still very dominant. And return on assets of private firms in the service sector is also twice as great as in the public sector. So if interest rates go up, I think more credit will go to the private sector. The returns are at least twice as high, perhaps 3 times as high in the industrial sector. And it will be possible to offset the slowdown in credit growth through a more efficient allocation of capital. So in the best scenario, you get the liberalization of deposit rates feeding through to higher lending rates. You get demonopolization in the service sector. You get a larger growth of credit, the share of credit going to the private sector, where returns are 2 to 3 times as high. And so you could have a slowdown in credit growth in which the slowdown in GDP would be substantially moderated through a more efficient allocation of capital through the banking system. So low probability of a financial crisis for all the factors I mentioned, and I'm trying to give you a sense of skepticism about this forecast that if they do moderate credit growth, that we're going to see GDP growth slow down to the low single digits. I think that's quite unlikely.
So while the slides are put up, let me just echo what Adam said, that I'm going to be speaking on my personal capacity. And, you know, we in the hedge fund industry have a disclaimer envy from the central bankers. So I say there that all the views that I'm going to express are my own and not those of the issue or anybody else. Hold on, not sure. Yeah. So Adam and Dave asked me to discuss what the risk to financial stability might be in the current situation. Essentially, what would be my advice to a central banker if I were to get the question, should I worry about financial stability risk? And my first reaction was, I don't really know what financial stability risk mean. And so what I'm trying to do in the next few minutes is first try to discuss with you what I think monetary policy should be thinking about when thinking about financial stability. And then think about 3 specific issues that maybe are relevant. The first one being whether the Fed is going to be able to keep rates as low as they claim they are going to be able to keep rates once the economy evolves as they expect. The second one is whether there is too much euphoria in the euro area periphery now that the spreads are coming down quickly. And the third one is whether there is any risk of an emerging market crisis or problem as QE ends. Many of these issues have been discussed by Dave, but I will try to give them a little bit of a macro-financial flavor to them. So the first point is really, what should monetary policy be thinking about when they talk about financial stability? Our President Kocharlakota and Governor Stein have been discussing this issue recently. So this is the way I think about it. Monetary policy traditionally has been dedicated to stabilizing growth and inflation. But there is another dimension of it that is uncertainty, that normally has been left apart. And so I think one way to think about it, which is what I think President Kocharlakota referred to as a mean variance approach, is that you worry about growth and inflation, but you also worry about the volatility of growth and inflation. And so in some sense, what monetary policy should do is stabilize the residual macro risk. You have macroprudential, you have regulation, you have microprudential, but there are things that those policies can handle, and that's where monetary policy should act. In some sense, is to stabilize risk attitudes. Now, what does that mean? and that's the problem. So in normal times, I think it's quite simple, quote unquote. Just don't make big mistakes, don't create one-way bets, and don't overpromise. And I think those are simple first do no harm principles for monetary policy that are simple to follow. The problem is when you are in a crisis and policy is at the zero lower bound, the key channel that monetary policy uses to boost economic activity is creating certainty and fostering risk-taking. So in some sense, it is a bit of a contradiction in terms to worry about financial stability risk when you are using risk-taking as the main channel of your action. And so the question really comes, how much risk-taking is too much? So this is where I start thinking about what, if I can find the, okay, what the current situation is. One way you provide certainty is by providing guidance, right? The way that monetary policy has been operating, especially what we call QE3, has been saying we are going to keep easing until a specific economic outlook is delivered. In some sense, the Fed is selling an insurance to the world. Now, is this too much? Well, this is a measure of uncertainty that is not terribly different from what Dave showed before. What Dave showed before was extracted from news reports. This is extracted from the volatility of the stock market. This is a variation of the VIX index that has become popular. It measures the expected volatility of the S&P over 3 months. Just eyeballing the chart, it tells you that certainty from that standpoint is not higher than it was in 2004 to 2007. As you can see, the line is higher. In other words, the uncertainty about the future path of stock prices is still higher than it was pre-crisis. So I don't think we can say from here that monetary policy is overdoing it. But at the same time, we are in a situation where the Fed guidance is very strong, right? They are telling us what they are going to do in words and with a chart, the famous dot chart. So I characterize the Fed stance as late, slow, and low. They are going to raise rates late. When they do it, they are going to go slowly. And they are going to end up in a lower point than in the past. And then they put the famous dot chart. So it's a little bit of a belts and suspender approach. In case you don't understand the statement, let me paint a picture for you, right? And the market really believes it. This chart essentially shows the green light, the green line is the market pricing today of short-term interest rates. The red light are the median dots from the FOMC's most recent statement of economic projections. And the blue line is the measured pace. The measured pace was the pace of interest rate increases of the 2004 rate hiking cycle. So what this picture is telling us is that the Fed is telling us they will do the red. The market believes they will do the green. But 10 years ago, they did the blue. And I'm simply leaving that picture there for you to consider, because we economists call this the problem of perhaps a policy that is time inconsistent. So what if they are telling us today this is what they are going to do, but when the time comes, they are not able or willing to deliver that? And this is one thing, as Dave, I think, was showing, all the risks that people are focusing today are basically whether inflation will be too low. Maybe there is a little bit of a bias towards that, and there is no consideration whatsoever of the possibility that maybe the economy recovers as normal, inflation becomes normal, and things have to be normal at some point. All right, second point, moving to Europe. As you probably know, if you've been following the news, spreads have come down very quickly in Europe. In fact, the 10-year rate in Spain, sorry, not the 10-year rate, the front end, the 2 and the 5-year rate in Spain and Italy are now below the levels of the US. And I've got many calls to explain why this crazy behavior is happening in the markets. And I don't think it's crazy. It simply reflects the evolution of monetary policy in the euro area. When Draghi said we'll do whatever it takes, then the correction of an abnormality happened, and markets realized that the default probabilities were very low if monetary policy was going to behave in a sort of more normal way. So there is this puzzle. So for example, you see Portuguese yields today are lower than Brazilian yields, despite the fact that the rating is lower. In some sense, I think what we are learning is that if the economic framework of EMU is sustainable, then the ratings are what are wrong, not the yields, and periphery real rates are still too high. This is a picture that, to me, illustrates very well where we are. The blue line is the GDP-weighted 10-year rate for the euro area, right? It's not the German rate, it's not the Spanish rate, it's a basket of bonds of the euro area. This is deflated by the 10-year forward inflation rate. So it's a measure of real rates. You can see that for the UK and the US, it has been deeply negative over the last couple of years. For the euro area, it has been highly positive. So what we have seen is that there has been a tightening of policy in the euro area, while there was an easing of policy in the US and in the UK, and that those levels still remain too high. So if anything, I would say there is not enough euphoria in the euro area. Real rates are still too high, given the growth and the inflation outlook, and that is one consideration we should have. Perhaps the fact that Greece today tapped the markets is another indication of this. I just learned while we were having lunch that not only the 10-year rates are approaching 6%, Greece today had tapped the markets at the 5-year point of the curve. It was tremendously oversubscribed. The demand was about 11 billion for a rate that is around 5.25%. So it seems that the markets, in some sense, agree, or sort of agree, with what I'm saying I up there. If there is something I would worry, is that inflation is too low. This is another way of showing what Dave was showing before. This is essentially a chart showing the term structure of one-year inflation rates as priced by the markets today. So what you have in the horizontal axis is one-year inflation 1 year ahead, one-year inflation 2 years ahead, one-year inflation 3 years ahead, and so on. What this shows is that during the good times in 2005 and 6, that line was very stable, 2.25% perfect credibility of monetary policy. Right now, we don't have that. What we have is that inflation in the euro area is expected to reach 2% only in 2021. And so if there is one risk I worry, is that between now and 2021, there is a negative shock. The euro area falls into zero inflation or deflation, and then the fiscal outlook for those countries that are in trouble becomes a little bit more compromised. The final point is emerging markets. I think by now we can agree that tapering is priced in, that some rate hiking cycle is priced in, as I showed before. And I think we can conclude by now that the taper shock of last year was really not the fault of the Fed. It was the problem that fundamentals in emerging markets were weak, and many people hadn't thought about it. So the policy mix in some of these emerging markets has improved. And the interesting thing is in the last month or so, the carry trade is returning. Let me show you one chart. This is the return of buying a basket of currencies, where you buy the currencies with the higher carry and you sell the currencies with the lowest carry. In other words, you buy the currencies that pay the highest interest rates and you sell the currencies that pay the lowest interest rates. This is what happened before the tapering shock. Everybody was happy and bullish about emerging markets. This is what happened after Bernanke said, maybe one day we will end QE. Came down here. So stabilization, but look at this. And this chart is not updated to the last week or so, so this is probably up here. Essentially what happened? Well, some of these countries have improved their fundamentals. Brazil has raised rates a lot. Turkey, India has been raising rates a lot. There has been some attempts at fiscal tightening. Some of the currencies have returned to levels more normal and more consistent with the standard long-term valuations. Now, there is one thing I worry, that is this, is the rapid expansion of corporate bond issuance in emerging markets in the last few years, right? Why? Well, because it's not clear to me that those companies that were issuing so much were expecting that rates were going to increase in their own domestic currency and the currency was going to depreciate rather than appreciate forever. So there could be some interest rate and foreign exchange mismatch that remains to be watched. But at the end of the day, it is a growth problem. It is a potential growth problem. Probably what happens is that emerging markets have a lower potential growth than they thought, but not necessarily a financial stability problem. So let me conclude here just by saying that monetary policy must generate risk-taking. And I think we need to keep that into account when we are at the zero bound and when we discuss the issues of financial stability. However, as normalcy is approached, there is a question of how much guidance you want to provide. And that is a trade-off that I think monetary policymakers need to deal with. The euro area periphery rates are still too high, despite the appearances, but that inflation is too low, and that is what really worries me. And finally, that emerging markets have a growth problem they have to deal with, not only from the economic, but also from a political standpoint. And if they can deal with that, the financial implications of that will be small. Thank you.
Thank you very much. My presentation will be on a more narrow issue. Yeah, here we go. So less broad in scope than the previous three, but an issue that is important and relevant to the global risk assessment, and that's the European Banking Union, but more specifically, as Adam said, the asset quality review process. And here my main message, and I'm slightly off consensus on this too, is that we're not yet out of the woods, and there are significant risks to watch in this particular process. So Europe's banking problem is now well known, well characterized. There are a lot of banks in Europe, and more importantly, they're very big. If you look at banking assets to GDP, and actually it's not very different whether you look at the Eurozone or the EU as a whole, they're vastly higher than in the US. They also increased in the boom period, the Great Moderation period, vastly more than in the US. Roughly 100 percentage points of GDP increase in the half decade before the crisis, which is, in hindsight, an enormous increase that should have sent alarm bells ringing very loudly. So the big difference from the discussion we had at the Euro area panel 6 months ago here is that now all the legislation on banking union is in place. Of course, I guess everybody in this room is aware of the initial push for banking union in mid-2012 when the leaders of the euro area member states said, we affirm that it is imperative to break the vicious circle between banks and sovereigns, and everything started from there. Of course, they didn't put a deadline on this, and when we look at the current status, it's really a half banking union. So if you consider pretty conventionally that the banking union has three pillars: supervision, resolution, and deposit insurance, you have 100% on supervision, almost. Basically 50% on resolution. It's a halfway house, a single resolution mechanism that was adopted last month and is being finalized. And 0% on deposit insurance, a federal deposit insurance system, which is completely off limits. Sorry for the many acronyms in my presentation. So SSM is Single Supervisory Mechanism, ECB is European Central Bank, SRM is Single Resolution Mechanism. We also have a halfway house in terms of where it's positioned between the Eurozone and the EU, by the way. So I think we'll increasingly talk about the banking union area as something in between the Euro area and the European Union. The UK is certainly not going to be a member of it, but we see that in Romania, probably Denmark, possibly Hungary and others, there are a lot of forces to enter the banking union without entering the Euro area. So in geography, it's not just a euro area issue, and actually when you look at the legislative basis, treaty basis for new legislation, the single supervisory mechanism was based on the euro area article of the treaty, the single resolution mechanism was based on a single market article of the treaty, and therefore it's a hybrid. So bottom line, this legislation, this half banking union, doesn't break the vicious circle between banks and sovereigns entirely, but it mitigates it partly, and how much, of course, will be determined by practice, but the fact that the SSM in particular prevents financial repression, prevents basically forcing local banks to take local debt on their balance sheet to a large extent, or at least we can foresee that, is a significant mitigator, and therefore a monetary union with half banking union is likely to be more resilient by a margin than a monetary union without banking unions that we have had for the past 15 years before the crisis. So I see progress. Now, the legislation is in place, but the new regime is not in place. And that's why we're talking about the asset quality review. The transition this year is crucial. The ECB will be the licensing authority for all those banks. I'm talking about the 100 plus largest banks in the system, which together forms a vast majority of the banking system in the euro area, or for that matter in Europe. And therefore, the ECB needs, the AQR was a necessity. The ECB needs to form a view on how sound these banks are before granting them a license. And we have all this because the former national regulators were not trusted. So the ECB really has to do that. They cannot take it as a given that the previous licenses were sound. We have what the ECB calls a comprehensive assessment. Everybody else calls it the AQR. So it's actually three pillars, of which the AQR is one: supervisory risk assessment, asset quality review, stress test. I'm not going into the details. What the ECB has said, importantly, is that there will be one single number for each bank in terms of capital gap, which might be 0, but this number will come from all the different components of the comprehensive assessment. So it doesn't come only from the stress test, not only from the AQR. And I'll come back to this. But I think the AQR is really the key difference with the stress test processes we had in 2010, 2011, and therefore crucial, and therefore it's quite logical that the marketplace would call the whole process AQR. But actually, when I think of the whole process, it's not only what the ECB is doing, it's also bank repair. And this, of course, is much more tricky, potentially, than just an assessment exercise. It's not in the hands of the ECB. There's a key role for DG Competition, the competition policy enforcement arm of the European Commission. And here, a game changer is that there are new rules from last year, which really makes the framework much tighter. There can be no disbursement of state aid before an approval from DG Competition. The junior debt has to be bailed in before any state aid, not the senior debt, but the junior debt. And there is even less flexibility for recapitalization or state aid that would not be approved by December 31st this year. So the AQR process has begun. There is an encouraging start. The legal basis is very strong. The ECB has enforceable access to information, not only from national authorities, but from the banks, things that the European Banking Authority could only dream of. The senior recruitments are encouraging. The communication initially has been strong. There are many consultants hired. Oliver Wyman for the whole process, the Big Four audit networks in different member states. More than 1,000 auditors have been reported to be already at work in the different member states. So all this is perhaps a bit belatedly, but being put in place. The ECB approach is to encourage banks to recapitalize proactively. So basically to fix the problems now, and therefore they will be given a clean bill of health in October when the results will be announced, or at least that's the doctrine. So we see actually this working to a certain extent, recent announcements by Unicredit, Intesa Sanpaolo, Dexia, that they would write down a lot of dubious assets and seek new forms of strengthening their balance sheet. But there are very few so far, and the hardest part is still ahead. So there will be problem banks identified, possibly insolvent, certainly weakly capitalized. And whether these problem banks can recapitalize proactively in that way is doubtful if their equity value is negative. So the ECB will have to decide how to manage how to deal with these problem banks. And here I want to highlight a dilemma which I think has not yet been sufficiently analyzed in the public domain. It's a dilemma between basing the capital gap assessment on the AQR as opposed to the stress test. And actually, if you look at, for example, Japan in 2002 or other episodes of systemic crisis resolution or attempts at resolution, this is an old dilemma. It's not new to this exercise. So it has been debated at the ECB internally since at least mid-2013 and still not resolved. So it's a very vivid internal debate from what can be assessed from outside. Assume weaknesses are uncovered in a bank, you can either go the AQR route or the stress test route. So AQR in the narrow sense, asset quality review, you look at, you basically reprice these assets in the balance sheet. It's an accounting exercise. Basically, that means that the management, the national regulators, the auditors have not done their job of enforcing proper accounting, supervisory accounting, financial accounting. And there would be restatement obligations and the like, everybody would lose face. It's a tough approach. The stress test approach is a much milder approach. You have a stress scenario, you give a supervisory opinion that capital should be stronger just to survive possible hypothetical contingent future stress. What it generates, however, is procyclicality in the system because you assume a harsher set of conditions than the current ones, unlike the AQR route, and especially from a cross-country perspective, you assume more stress in periphery countries than core countries. So politically speaking, the stress test route is good for Germany, bad for Italy. The AQR route is much more neutral. Also, it's very problematic to impose bail-in obligations through the stress test route, both politically and also legally, because you're just giving an opinion of the supervisor would like you to have more capital, but whether you can breach a contract with a junior creditor on this basis remains to be seen. So this is a key choice for the ECB. They haven't decided on this. There are other challenges. I'll be very quick on this. The ECB lacks experience of all this. There are problems of communication on a legal basis. If the bank knows there is a gap early in the process, should it disclose it to the marketplace? There's a lot of confusion at the ECB on this, as the quote from Jens Weidmann illustrates. And of course, the restructuring piece itself is going to be very tricky for the member states. Some member states, including France and Italy, two large ones, are not ready, don't have legislation for junior creditor bail-in, so basically they cannot give state aid on the face of it. There are many tensions between the ECB, DG competition, and there is no good structure at this point to manage these restructuring in terms of asset management companies and the like. There might be issues if you think that the two chair and vice chair of the SSM, the single supervisory mechanism, were respectively the top supervisors in France and Germany until very recently, so they have to manage personal reputational challenges which might be tricky. And all this is very important because the proactive recapitalization approach of the ECB hinges on credibility. So if the marketplace gets a sense that the ECB might become a bit weaker in all this, suddenly this strategy could become much more difficult to implement. So where are the gaps? For lack of time, I will go very quickly here. Basically, I don't know. It's very difficult to tell from outside. It's a moving target, and there might be surprises coming from the external environment. So basically, the AQR is really a discovery process. And the question then is, what is its likelihood to be successful? What is success? It's not the big numbers that will be announced in October. So success is really whether the ECB and the whole process is able to heal the wounded banks and kill the zombies. So basically not repeating what happened with Dexia in 2011. So basically this assessment of success or failure is probably not likely to be made immediately at the time of its announcement, but sometime later. And really the question here is, can it be done without more turbulence? The market consensus at this point, but I think it's really for lack of attention of the market because they have focused on so many different things that Angel and others have presented us today. They think it's solvable, that basically the ECB will have a bit of forbearance, the member states will restructure some small banks, and they can meet somewhere in the middle. But it's not clear to me that they can bridge the gap that way. If not, there might be significant escalation, political stress. It's always difficult to restructure a bank. I don't think we're at the point where this is likely to disrupt sovereign debt markets. So I'm not saying the return of the vicious circle per se, but a very difficult political sequence between now and the end of the year that might, in a tail scenario, generate institutional deadlock. And this is important, of course, I conclude here, Adam, because if the AQR is successful, you can have a benign scenario of confidence returning. If it's failing, the ECB loses credibility big way, and therefore you could have a return of risk into the Eurozone that would have broader consequences. So the next few weeks and months are important. My own assessment is benign, but I'm not reassured yet. Thank you very much.
Thank you all. I realize that was a very intense, longer period than was expected. Our scholars are coming up to the table and are ready to take your questions. There's a moving mic with Jessica here in the front. If you identify, and those of you towards the back can come to the standing mic. When I recognize you, please identify yourself. So Bob and then Jose.
Bob Samuelson, The Washington Post. This is for Nick Lardy. Nick, two-part question. One, could you describe what a financial crisis would look like in China if one occurred, regardless of your own feeling about whether one is likely? Secondly, in your presentation, you did not mention the large amounts of credit that have gone to the real estate sector, which you have emphasized in your writings. I think you told me that the amount of the size of the housing and real estate sector had doubled over the last decade or so. Can you describe why you don't, if in fact a financial crisis is avoided by curbing credit, why won't that lead to a slowdown operating primarily, if not exclusively, through the housing and construction sector?
Well, let me take the real estate first. I think, I didn't say it, I should have, I think real estate is a much bigger risk in China than a financial crisis. I think of real estate as being a macroeconomic risk. China's very unusual. It's investing an extraordinarily high share of GDP in residential property, but the degree of leverage to finance that expenditure is relatively small. So housing and residential housing investment last year was almost 12% of GDP, which I think is higher than any country in the world has ever experienced, with the possible exception of Ireland or Spain, about twice the US peak. So they're over-investing. I think real estate will not be a preferred asset class indefinitely, and when that extra demand moderates or disappears, we could see a very substantial slowdown over a period of several years, but it would not necessarily lead to a financial crisis. So I think of it as a macroeconomic crisis because real estate has been the big driver of aggregate demand. Now, what would a financial crisis look like? Well, I think it would look very different. There's not going to be a sudden stop in funding because this is all deposit financed. The deposits are not going to disappear because there are controls on capital movement, so the depositors have very few alternative places to put their money. So a financial crisis in China is going to look something like the late 1990s, where the accumulation of non-performing loans becomes so large that you have to have a massive recapitalization of the banking system, something in the neighborhood of 25-30% of GDP. So that's something we have seen before. They are still working through the aftermath of that, but if you can keep GDP growth up, financing even a massive recapitalization turns out to be feasible. The real cost, of course, is the wasted assets that result from the misallocation of credit leading up to the big accumulation of non-performing loans.
Terrific. Thank you. Jose.
Yeah, I have one brief question.
That's
to Dave.
Jose de Gregorio,
Sorry.
Senior
Jose
Fellow
de
at
Gre-
the Institute.
Jose de Gregorio from the Institute. I would like to ask David one simple question, and this is your assessment about the Abenomics and three arrows for Japan that's growing 1.3, 1.5 for the next 3 years. It's been successful compared to previous history. How is working? Because it's more than zero that they used to have, but it's still quite low. And there was Angel made a very interesting discussion on tapering, but I'm not fully sure if he said that the tapering announcement basically caused a lot of turmoil in emerging markets, and this was because of weakness in emerging markets, but also we have to recognize that the tapering increased interest rate for 10-year bonds about 100 basis points in a couple of weeks. So that was quite a shock. And now this created, of course, a lot of adjustment in asset prices. But then now recently we see things turning around. And there are two risks or two views. One that said, well, this is transitory, and the other said, this is here to stay. And your view, it seems to me, you say that the carry trade, the returns have improved for capital inflows to emerging markets. We have seen capital inflows. But then you say because they are doing structural reforms, and Brazil is raising rates, but that's not a structural reform, just that's a rate hike, and that's the same in India. So nothing different is happening, I would say. Indeed, my view is that in emerging markets, economies are slowing down, and this will put a lot of pressure on monetary policy to start to loosen, so we can see a reversion on the carry trade.
Before Dave and Angel reply, and I might stick my oar in on Japan, I should point out that Jose is among our speakers tomorrow afternoon here at our Moody's PIE Joint Sovereign Debt semi-annual meeting. Jose will be talking about risks in Latin America. Arvind Subramanian will be talking about the emerging market picture writ large, and Anders Aslan will be talking about Eastern Europe along with colleagues from elsewhere. Dave. Sorry, I try to signal where the mic goes next while you're talking. So talk.
Very good. So, My expectation, or at least what's built into this forecast, is that the third arrow includes a package of relatively weak structural reforms, not aggressive measures that might, for example, lead to a significant increase in labor force participation by women, might not, in fact, result in substantial labor market reforms that would increase flexibility and increase the ability to hire. I see that as an upside risk, but I guess at this point, am skeptical that they're on track to, in fact, expend the significant political capital that we require to get much bolder structural reforms. Now, Adam has obviously weighed in on this issue publicly as well.
So I'm recently back from Tokyo. I think we're in the glass is 1/4 full situation. There is more there than there's been in the past. There's a little less there than I hoped a few months ago. In line with what Dave said, the 2 points. First, that this announcement they made a couple weeks ago about the special economic zones they're putting in place really is a backdoor labor market reform and attempt to increase competition in healthcare. And in line with what I wrote in the FT, this is actually a good set of priorities. They may not be doing it as aggressively as we would like, but it's actually, as reform priorities go, it's a reasonable place to be. But I think the more important point where I definitely want to echo Dave is there's this tendency to assert that Japan can't grow absent structural reforms, and Bill Klein's written about this a bit as well as me. You look at their per capita GDP or their productivity growth record since 2003, it's actually quite good by G7 standards. Not good by historic Japanese standards, but quite good. And so the notion that absence of structural reform isn't an upside risk, as Dave puts it, I think is right. The notion that it's a constraint on getting growth above 1.5, I think is wrong. So you should look at it in that framework, in my opinion. Angel.
So let me clarify a bit what I said. What I meant to say is this. Yes, when the Fed last year announced that maybe they would be tapering, there was an increase in term premium. And that's what affected, in some extent, all asset prices, right? That increase in the term premium has sort of stabilized. Since then to now, there has been some action in some emerging markets. I don't remember if I said the structural reforms, but if I said that, I didn't mean that. What I meant to say is some correction of mistakes, some adjustment of monetary policies, some correction of some intentions that look misplaced. And at the same time, there has been some movement in some of these exchange rates, which look less overvalued than they look a year ago. Now, I don't like to call it carry trade. Just call it, flows to emerging markets in general, because the world may be underinvested in emerging markets, and they are going, I think, to continue with ups and downs, as it always happens when you have a tightening process in the other major economies.
That's great, thank you. We have Mark and then Barry at the back.
Mark Finley with BP. Adam, thanks to you and your panelists for putting on a great program as always. Question, I guess, for Dave, although welcome other panelists' views as well. In the U.S., how big of a deal is income inequality for the U.S. macro picture over this period? You showed a chart on suggesting that at least some of the impact on wages as a share of the economy was cyclical rather than structural. So how much of this dynamic is cyclical versus structural, and what, if anything, is to be done about it?
So they're both cyclical and structural elements. As I said, they're like in the labor share, there had been some downtrend even prior to the crisis, but I think the weakness of the labor markets that's followed since the crisis has exacerbated that. Now, in terms of the implications of this sort of for the macro picture, I think one way to think about this is the change in income inequality could be one factor behind, in essence, the low interest rate situation that we're confronting, because what it means is for any given level of income, more of that income is going to people who have a lower marginal propensity to consume than has been the case in the past. And so in essence, to equilibrate supply and demand requires a lower interest rate. And so that, I think, could be more structural and a long-term factor than a short-term factor. My basic point on the macro side is that I think we still need to be pursuing as best we can, subject to the constraints perhaps imposed by financial stability concerns, efforts to promote much tighter labor markets than we currently have, because I think the evidence strongly suggests that that is both bad for social reasons, but also bad for macroeconomic reasons.
At the back, Barry, and then John here, and then the lady at the back.
Barry Wood, RTHK in Hong Kong. Along the same lines, Dave, what would be the impact of a rise in the minimum wage in the United States? I gather from your comments about the slackness in the labor market, you think it could go up, or at least wages could go up without an inflationary impact. How much of an increase before there would be an inflationary impact, and what would be appropriate if you think it is?
So clearly that's a complicated question. I don't think the kind of increase that the president has currently proposed, to $10.10 an hour, would show up in any significant way in terms of aggregate price inflation. It really is a very small effect. Likewise, the macroeconomic effects, some people have touted the macroeconomic effects of, wouldn't that be raising incomes, produce exactly this kind of shift in income towards people with high marginal propensities to consume. That effect would be very small as well. In fact, I think it's easy to exaggerate on both sides the impact of the minimum wage. I don't see that either as an important element in changing income distribution, or people talk about it lifting people out of poverty. I mean, what it talks about, what it really means is moving people from a little bit below poverty to maybe a little bit above poverty. Those might be good things. I do think we have other more effective tools available to address this problem, and I do think moving more in the direction of being more generous on the earned income tax credit, and especially for single people, as some people are proposing, would probably be a better direction to go in. But if that is completely politically impossible, then a small increase in the minimum wage, such as the president proposed, would probably be reasonable at this point.
Thanks, Adam. John Macon, AEI. Dave, you and others kind of mentioned an undertone of concern that inflation is lower than you'd like to see it. The other thing that we can observe is the Fed is, if anything, on a modest tightening track. So what if inflation drops another 50 basis points in the U.S. on a trend basis? What will the Fed do?
So I think actually that could be a real constraint on policy. I don't think that will happen quickly enough for the tapering to be adjusted. In fact, I think we're pretty much on a track to end that program in the fall. But on the interest rate side, and what the Fed communicates about interest rates, I think they would be more seriously concerned if they saw the trend in inflation continuing to move lower. And as well they should be. I think that really would pose some significant risks, especially if you thought, I mean, not just that, that the world is dramatically different with 0.5% PCE inflation than 1% PCE inflation, but the risks begin to accumulate that if you got any kind of a negative shock, that you could move more seriously into a deflation that would have both consequences for spending patterns and increase the burden of servicing debts, I think would weigh on Fed considerations, and probably either push off the date of the first tightening or maybe make the path of the dots that they're currently showing even more plausible.
And then you have to pray that the dots are as effective as Angel's parallel lines are, because some of us might worry a little bit that if they're not actually buying or doing anything, it becomes cheap talk after a while. But I think it is important to recognize, as you raised, John, and as Dave puts it well, but I'm going to be a little more pointed, an underlying theme of, in a sense, all four presentations is that there is something of a trade-off on being careful about credit growth and financial stability writ large and GDP growth. That's not the same, though, however, as saying monetary policy is the way to square that circle. And I think Angel and Dave, at least, would agree with me that we might share concerns about financial stability without believing that should be constraining monetary policy from reacting to low inflation. You should be going after financial stability with other means. And that gets into some of the things in China that Nick talked about and some of the things that Nicholas talked about in Europe. which is why we're here. We actually do have a common theme. Please, at the back.
I'm Jennifer Lee with Hong Kong Phoenix TV. Question for Dr. Lardy. It's about China's exchange rate reform. So we see the renminbi has been depreciating, and it's so raised on guessing that what's China government's intention. And most of the guessing is they want to drive away the hot money and also curb the asset bubble. So what's their intention, do you think? And the second, it also raised some concerns. For example, the US government has shown concern about it. Do you think, is there any concerns? Thank you.
Well, in short, my view is they are taking this action, having the exchange rate depreciate for a period of time to reduce the incentive for the carry trade that's been somewhat disruptive for their monetary system. I don't think there's a fundamental change in policy. I think they are genuinely working to have, two-wave movement in the exchange rate rather than constant slow appreciation. They've widened the band. I don't think they're moving to gain some trade advantage by reducing the value of their currency by 2.5%. First of all, it's too small to make that much difference in the short run. So I would quite frankly think that the criticisms that have been raised by an unnamed senior official, I think, are a little bit premature, particularly in view of the fact that we now have the revised current account surplus for last year, and it's only 2.0%.
That, just to be clear, that's their overall current account surplus with the world, not their bilateral
Yes.
U.S.
Yeah.
Which is fine, but we just need to be clear. We're past our witching hour, but I'd like to end at 1:45. So, Lee, you have the last question.
Yes, my question is for Nicholas.
That's Lee Price from FDIC.
Lee Price from the FDIC. I'm sorry. So we heard this morning about risk of falling inflation in Europe. That makes debt problems more difficult to pay off. And your presentation today, Nicholas, talked about only 50% of the supervisory mechanism seems to be accomplished, and 100% for the supervisory mechanism. But I worry about the 100% accomplishment of the supervisory mechanism if they don't have reliable resolution. If they're going to look at 130 banks carefully, there probably are a few of them who should be resolved at the end of the day, that don't have the asset quality to justify their continued existence. If they don't have countries and a mechanism for resolving those, then that's going to put pressure on them actually doing what they need to do about supervision and setting bad precedents. Because if they can't resolve the bank, then there's going to be pressure to have forbearance, and that sets bad precedents. Are you worried about the supervisory mechanism being able to deliver if they don't have a resolution mechanism that can deliver?
Yeah, I'm sorry I didn't enter into this very important discussion. I felt my presentation was already way too detailed and with way too many acronyms, but there is a sequence here which on the face of it is absurd, except if you're working in the German government, in which case it makes a lot of sense. And the sequence is there is a legacy to manage. This legacy will be managed by individual member states individually, and after this legacy has been dealt with, then we have a common resolution mechanism with some degree gradually increasing of financial risk mutualization. So that means that each member state needs to have in place a national resolution mechanism, which some of them don't have right now. And then after that, we create the 50% single resolution mechanism or the half single resolution mechanism. I don't know what's a half single. In terms of a European framework. So what's the status there? Many member states have an effective resolution mechanism in place. That's the case of the UK, but also in the Eurozone, probably of the Netherlands, possibly of Germany, they're updating it, certainly of Spain and Portugal and Ireland. But some of them don't. And I mentioned France and Ireland as two member states
France and Italy.
France and Italy. I need to drink more coffee. As two which might have a problem because their legislative framework is basically not in line with the policy framework of the asset quality review. And I think this is a space to watch. Now, the good news is emergency legislation can be passed much quicker at the national level in Europe than at the EU level. And we don't need EU level legislation for this, but this is why I said the next few weeks and months are important, because there is a lot of work still to be done to have an effective framework, even if you accept the German view that this is legacy and therefore in resolution terms dealt at the national level for the time being.
Terrific. Thank you, Nicholas. Thank you, Angel. Thank you, Nicholas. Thank you, David. And thank you all. Very rich discussion. And yeah, your applause is welcome, of course. But just to remind people that the presentations are available on the Institute's website. And if you want to listen to their beautiful presentations again, so is the video. And we'll look forward to seeing you long before our next semi-annual Global Economic Prospects meeting. But Dave will be guiding us through another scintillating set of themes in October. So thank you very much.
Thank you, sir.
Good.
Thank you, sir.